This program is brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. IG, where traders are made.
So the stock of the day is Super Retail Group. UBS this morning upgraded its rating on the company from a neutral to a buy, and the target price was lifted from $13 to $15 due to higher than expected earnings in the forecast. And why? UBS formed its improved view on Super Retail after the consumer confidence data that came through yesterday, pre the inflation data today. It says that consumers are still going strong, and UBS analysts expect an increase in consumer discretionary spending as the year moves on. It's pointing to Super Retail's store growth, online growth, and a growing club membership, as well as its active efforts to grow customer value in improving earnings. So let's look at how the share price is faring. It was the best performer on the 200 heading into that inflation result. So let's get an expert view from both of my guests. I'll start with you, Ben Richards, in studio from Seneca Financial Solutions. Would you be buying Super Retailer today?
I wouldn't be buying it today. We don't mind it. We think it's a pretty good quality business. Any retailer that can do 10% profit before tax margins is pretty impressive. In terms of brands that they own, things like Super Cheap Auto, Rebel Sport, BCF and Macpac. But you know, in this current environment, we've just talked about inflation, cost of living pressures, particularly have been rearing their ugly head over the last sort of 6 to 12 months on a bit of a lag from the interest rate hikes. And yeah, we think the retail sector on the whole is a bit vulnerable to that. As recently as last month, I believe, Bapcor downgraded earnings for, I think, the third time. So that doesn't bode particularly well for Super Cheap Auto, which is about half of group earnings for Super Retail. And Kathmandu as well is another one that's downgraded, which is pretty similar to Macpac by, you know, demographic and exposure. And yeah, although shares have pulled back a bit from their high of about $16, we don't think it's super cheap, if you'll pardon the pun. It's on about 13.5 times forecast PE, 5 and a bit % dividend yield, fully franked. So it looks okay on a valuation metrics basis, but it's just the earnings risk that we're concerned about. If you're desperate to own retail stocks, we probably prefer ARB in the space and see that as a pretty high quality category killing brand exposed to kind of the four-wheel drive thematic. So just not the right time in the cycle for us to be owning Super Cheap Auto.
If you had it, would you hold it?
Maybe a hold. Between a hold and a sell, Nadine.
So I think people will say hold at best, and I
Hold
let them
at
get
best.
away with it. Yeah, interesting. And I like how you're playing this with me. First time on together, but you've already given me a bonus buy. I like it. All right, let's go to Andrew Whiteland. Are you of two minds about Super Retail? Because when we talk about demographics, you know, in some ways it does cater to that older cohort, which we know are still spending. But then I think about Rebel Sports, and I think about me and my kids, and they're both squeezing into old soccer boots this year. I didn't feel like buying new ones. What do you make of Super Retail?
I'll just pick on Ben for a second. I'm not sure what to make of Ben. I'm not sure whether Ben's a crawler or whether Ben's just playing the game. Ben's smart, obviously. I'm not really sure. Anyway, great to have you on, Ben. Look, from a super cheap, it's not super cheap in my humble opinion. I'll continue with Ben's well-timed pun. You're being asked to pay 13 times earnings for forecast earnings per share growth of -1%. I do like the return on equity is close to 20%. As you know, I'm a big ROE fan. Quality is a factor, so it certainly ticks that box. And margins aren't too bad, as Ben alluded to before. But I'm not very sure. I'm pretty sure we're now looking down the barrel of another interest rate rise, and certainly consumers are under a fair bit of pressure already. Retail running super hard all the retail companies running super hard in anticipation of rate cuts coming as late as this November, December this year, or I think the market had been hoping for February next year. I think we can say goodbye to that. So all these retailers are going to be under pressure. This is not a space that you want exposure to. If you're still holding it, it's trading near consensus, so it's probably a tentative hold, but it ain't a buy, Nadine.
Thank you. All right, guys, Super Retail was the stock of the day.
This program was brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended hours on key US shares and competitive spreads, all on an award-winning platform. IG, where traders are made.